Welcome back, and I'm very happy to have Omri Thomas in the room with us now. Omri, thanks so much for joining us for the Q1 Fund Manager Report Back.
Thank you, David.
Omri, I have to confess, last time I think I asked you or interviewed you for Q1, I had a slip of the tongue and called you Tomri at the beginning, and we chuckled about it then, and my colleagues have not let me down. Let me forget about that. So I'm saying Omri with a very...
You got it right this time.
Yeah, with a very loud elocution. I want to start talking about performance. We're going to go straight into it here. Mansour, my colleague, who's the lead analyst on your fund, said you've done 24% to the end of Q1 for the last 12 months, and I almost had to go double check those numbers. So maybe talk a little bit about where the meat and potatoes is behind that 24%.
Yeah. No, thanks, David. I think if you look at the performance, I was quite surprised when I looked at the numbers, because it felt like a lot tougher environment to generate returns from. But I think, as you know, we tried to achieve two things: beat inflation +5, and to have no rolling 36 months of negative returns, or 24 months of negative returns. And I mean, if you look at all the performance periods, we're actually quite pleased with that. The last year was particularly good, but I think if we look at the longer term numbers, that's what's more important for us. And if you look at our inflation +5 target, since inception, we've been able to meet that target. So that is what we're trying to achieve. And it's also, one has to look at the risk-adjusted return. So the Sharpe ratio relative to the return that you got. So your return per unit of risk. And I think that's a more important number to focus on. And if you look at it relative to peers, relative to the market, it's quite a reasonable return.
Okay, so you're getting that sort of risk-reward sweet spot, if you will.
Yeah, that's the main aim. So I mean, your question on where has it come from, and to unpack it a bit, I mean, if you look at the returns over the last year, it's been mostly equity driven, both global and local, and then also our positioning in the long bonds specifically also helped a lot. So our global equity exposure, it was stock picks, but also a lot of our structured notes sit in the foreign equity part of our portfolio. So those two contributed quite nicely. And on the local equity side, a lot of our long-held positions came through nicely. And then also some trading opportunities. As an example, Naspers process sold off heavily after the concern about Tencent earlier in the year.
Yes.
And we introduced a 5% position within the fund from zero. And we saw a very nice bounce back in both those shares, which contributed to performance.
And then some of the sell-off when the Chinese government were looking to impose a little bit more regulation on it, and then those sort of stocks.
No,
are you talking more about that? Sorry.
No, it was when the US classified Tencent as a CMD company, so a company that supports the Chinese military.
Oh, okay. So when you said the start of the year, I wasn't sure which start of which year you're talking about.
No, start of this year.
Okay.
Sorry, yeah, that's a good question. So Naspers process contributed nicely, and then some of our Chinese tech shares that have also been long-held positions, so QFi and Alibaba both contributed nicely, and then one of our long-held positions, TBC Bank, also doing very nicely.
Okay, brilliant. Yeah, I mean, when you say 24% in the last year and your inflation targets +5%, inflation was certainly not 19%.
No,
so you did all in the last 12 months, but you're right, you need to look over multiple periods and what's the risk appetite you're taking at the same time. I see we going to the big elephant in the room again, which has been a foundation for many of our discussions this morning around Trump and the tariffs. And he said it's the greatest word in the English dictionary, and I'm going to be dreaming the word tariff the whole night tonight. I've said it so many times. But where are you seeing value from a regional perspective? I think that was quite interesting for me, because I know you have...
Yeah, so I mean, we were quite concerned about valuations in the US. And I think the whole tariff story has just elevated that risk. So I think the global risk premium has increased. So we've had very little US exposure, and I mean, we make a joke out of it. It used to be MEGA, make America great again, but that's changed to MEGA if you look at the performance since Trump's appointment. Europe actually having substantially outperformed the US, and it still looks like that could continue. There's inward focus now in Europe, and you're starting to see capital being spent within Europe, and the markets like that. So you've actually seen Europe doing quite well. I mean, we still like China. China has outperformed the S&P, but I mean, if you look at the longer term chart, it's a blip. Valuation is still reasonably attractive. One has to sort of counter your optimism because there are a lot of regulatory risks and geopolitical risks associated with China. So from a portfolio construction point of view, you don't want to overextend yourself there, but it's a very attractive part of the market to us. Naspers and Prosus also one has to add to that exposure. So it was a tactical trade when the shares were down significantly. So into the rally, and as markets turned a bit wobbly, just from a risk management perspective, we actually took quite a bit of profit on both Naspers and our Prosus position.
Okay. A couple of things. Mega, is that your acronym, or is that a market one that I've missed?
It could be a market one.
Okay.
I'm not sure, but it actually just looked interesting. So
okay, wait till it lands on Trump's doorstep. He might ask you to change it back again. And then on the China side, he does say that what would he say? He said they're probably going through a major crisis, and but they're still growing at something like between 5 and 6%, right?
Yeah.
So your exposure there, is it largely? Is it diversified exposure? Are you looking more at maybe the consumer story there? Is it the government spend on infrastructure, EVs? Where's that?
So it's low capital businesses, so with low capital intensity. A lot of it exposed to the Chinese consumer, and a lot of it exposed to tech. So I'd say those are the three broad themes within our exposure. Okay. It differs a bit. Some it's financial, some's consumer goods, some trading platforms like the Alibabas and the JDs. So that would be the common theme. Also, we're reasonably strong balance sheets. A lot of them are doing share buybacks and trading at attractive EV to EBITDA valuation levels.
And these tech CEOs that went missing are back in the public space.
Yeah, exactly. That's in the Chinese culture. It sends a very strong message.
Okay, strong statement. Okay,
it's a strong statement.
Okay, yeah, I know they're trying to flip the economy to be a little bit more diversified away from America and internal looking as well, and trying to drive that.
And they're also starting to engage with their neighbors a lot more, and trying to position themselves as the stable ally, unlike the US, which has become very unpredictable.
I believe even sort of bilateral agreements and conversations with Japan, which was unusual.
It's unusual. Yeah.
Okay, interesting. So we spoke about the Chinese consumer a little bit. I want to bring it back home to the SA consumer and our tax burden. And I sometimes don't know whether to cry or laugh when you realize how much tax we pay away. And you want it to be spent efficiently. So, how do you see that burden affecting, I guess, what's happening here locally? Because there's no much more scope, right, other than this VAT that we might have been seeing recently?
Yeah, it's interesting. I mean, if you look at the graph, 3% of the population actually pays 80% of personal taxes. So it's a very small portion that carries a big part of the tax burden. Now, there's been a lot of talk on increased wealth taxes. The problem with that is that that could drive changed behavior. And what's interesting, Norway tried that a couple of years ago. They said, well, let's just add a bit of wealth tax, and they estimated they were going to get something in the region of $150 million of additional taxes. So the result, as a result of that increase in tax, $54 billion of assets moved out of Norway.
Oh, wow.
Which was a net negative impact of $450 million. So they expected an increase, and in the end it was a massive decrease in the taxes. And I think that is the risk. In South Africa, the wealthy are already taxed to the limit, and I think that's why they try to do a broad-based tax with VAT. But I mean, our poor is already overburdened with the social costs. So what needs to happen, and I think that is what the DA is also trying to push for, is let's look at spending reforms, rather cut the spending and do the savings there than just continue to increase taxes.
Now, I've bought a beer in Norway. I know I know how much the value-added tax on those things are. You can remortgage your home for a six-pack there. But
exactly.
I guess in many ways they're very different population and culturally to many parts of the world, quite homogenous, same people. And
But it's more just the consumer behavior.
Yeah.
What happens, and I think the same will happen. A lot of it's already happened, where we've seen financial immigration by a lot of wealthy people in South Africa.
And they have the means to do it.
They've got the means to do that.
Okay.
Exactly.
Interesting. So it's quite a balance that you have to strike right. And
yeah.
You know, the headlines around the GNU are quite negative, but actually it's almost robust democracy in a lot of ways, that there are these checks and balances that are happening and you're being tested on things. Yes, it creates uncertainty, but it's interesting to track those mechanisms. And
exactly. 5-6 years ago, the budget would have just been pushed down into the throats of the SA citizen. And now it's been challenged. And not only by the DA, a lot of the other parties are also saying, listen, we can't afford a VAT increase.
So again, there's different perspectives at the table, which I guess is a good thing.
Spot on.
Hopefully. I think the market just wants clarity. What is the clarity? Because we like clarity, and there's so much cloudiness and uncertainty it's adding fuel to that uncertainty fire. I just want to go, I think, for our penultimate point here around valuations on different asset classes. Because I think you have a slide with a table showing where you think they're currently sit, where you're seeing value at the moment. Yeah,
so we still think China's, as I mentioned, looks attractive. US bonds, US cash. The rand we think is oversold at current levels. SA equity is actually interesting. It's almost divergent. There's some very expensive assets in SA and then some very cheap. So the local consumer-facing shares actually look very attractively priced. The likes of the banks, the retailers have come back a long way, and especially with all this recent uncertainty around Trump. So since quarter end, we've actually made quite a few changes to the portfolio and added exposure to those sectors. SA bonds.
You've been quarter end since end of March now?
Since end of March. Okay. So in the first 2 weeks of April.
Okay.
Yeah. We reduced our bond holdings, especially our inflation-linked bonds that held up fairly well, into some of the shares that were very hard hit. And since then, some of your purchases, and it allowed you to also buy some quality shares at reasonable prices. So the likes of a ShopRite, First Rand we bought at 56 Rand not too long ago, and it's already up more than 10% from there. Truworths at very attractive levels, up over 10%. Richmond, Capitec, so some very good quality companies that you could buy at reasonable valuations. And so actually just rode into that weakness, increased our exposure to risk assets.
Okay, yeah, because as staff from Nedbank, we also get daily emails on that share price, and you just see it kind of yo-yoing a bit recently.
It's been phenomenal, the volatility.
Yeah, and First Rand, similar sense, the banks offer quite a nice dividend yield at the end of the day as well.
Absolutely, yeah. Okay. Yeah. Okay. And they're more exposed to the local economy than to the global economy. So, and they're reasonably defensive historically as well.
Okay, great. Thank you, Omri. And then the final slide, I think, for today is around your positioning. Really.
Yeah.
Maybe talk us through some of these.
It's also quite a stale slide. It's funny that 2 weeks can be stale, but you would see that TBC Bank remains our biggest position within the fund from an equity perspective. Our banking exposure reasonably high, with both ABSA and Standard Bank being our top 10, and more recently we've also bought a bit of First Rands and Capitec added to that exposure. Naspers, since quarter end, we've actually sold out of Naspers completely, and a very small position in Process left. But from an asset allocation perspective, we have got quite a high equity allocation into this sell-off. Our limit is 60%, and we're currently sitting at about 57%. So both equity purchases, and then one thing I haven't spoken about is that we've also used this weakness and increased volatility to increase our exposure to our structured note basket. So we've added 7 new structured notes at coupons in rands of high 20s, so 27% probably on average. And so there's three rand-based structured notes, and then 4 dollar-based structured notes where our coupon there was about on average 26%. So very good returns that you could lock in at low levels that provide you opportunity for future alpha.
Okay. And before I let you go, an interesting position from you is Raubex there. Maybe talk me through some of the thesis behind that one.
Yeah. So Raubek's very involved in the construction sector in South Africa, and probably the biggest road builder that's left in South Africa. Now, our road building capacity in South Africa has been decimated because our SANRAL, I mean, the order book of Raubek's was always the biggest part of the order book. That went to zero. Okay. And there's been a big sort of gap and shortfall that's happened in terms of infrastructure spending. And there's a catch-up that's starting to happen. And that catch-up is going to take a couple of years. So at the moment, Raubek's, they've got a record road building order book, even prior to SANRAL cutting their projects. So very robust order book and still a very attractive valuation. So good earnings prospects for the next couple of years.
Yeah, I thought that was interesting for me. I mean, going into SA sort of infrastructure and confidence that the government's going to spend something on our roads.
Well, we've been forced to. So
Okay, brilliant. Omri, as always, thanks for your time today. Really appreciate it.
Thanks a lot.